Welcome to Knowledgeable Aging. I'm your host, Jason Kotar. Joining us today to talk about reverse mortgage strategies in retirement is Ernie Castro. Ernie has spent the last 13 years of his career originating reverse mortgage loans in the DC metro area. His expertise, understanding, and ability to work through complex problems has helped him close nearly 400 loans. Thank you for being here today, Ernie. How are you?
Jason, it's a pleasure. Thanks a lot. I'm doing great.
Yeah. Great. Well, before we get started, Ernie, for those joining us today, if you have any questions, type those questions into the box, and time permitting, we will do everything in our power to get those answered. So, Ernie, reverse mortgage strategies in retirement.
That's right. My objective here today is just to introduce everyone to the reverse mortgage, what you need to know, some of the changes that have happened, quite a few changes over the last few years, and how strategies using reverse mortgages are being employed by financial planners and post-retirement plans. And I'm just going to start by reading from Dr. Wade Pfau, who is probably the leading person as far as research on using reverse mortgages in retirement strategy. And this is from Chapter 6 of his book on how to use reverse mortgages to secure your retirement. Conventional wisdom on how to treat housing wealth in retirement was to preserve it as a last resort option. If it did not need to be used, the home may be left as part of the legacy for the next generation. However, starting in 2012, a series of articles were published in the Journal of Financial Planning investigating how obtaining a HECM reverse mortgage early in retirement and then strategically spending from the available credit can help improve the sustainability of retirement income strategies. So it's been a fairly recent development that this product has started to be included in financial planning. And we're no longer considered the loan of last resort. We are appealing to the mass affluent segment of the older demographic now. So that's what I wanted to let you know, how this has developed recently over the years. So there we go. This is just a simple diagram, kind of shows how mountain climbing, retirement kind of have some similarities. During life, we're ascending. We're trying to get to that pinnacle, which is retirement. And there's different strategies and different ways to do that, to reach that pinnacle. And this is called the accumulation stage. We're working, we're saving, we're investing until we get to the top, by the time we want to retire. And then the descent on the way back down, that's our distribution phase. And this descent is where we're pulling money from investments and assets to live the type of retirement that we can enjoy and thrive in. Now, most retirees share the same common goals in retirement: longevity. You know, you retire at 65, you don't know if you're going to be in retirement for 15 years, 20 years, 25, even 30 years. So you have to keep that in mind when you're planning. Your lifestyle, what kind of retirement do you want to enjoy? Do you want to be able to do the things that you've dreamed about doing all your life when you're in retirement? Liquidity, you need to balance your portfolio. Needs change constantly during life. Events happen where you might need more liquidity. And finally, legacy. What do we want to leave the future generation? What is your legacy going to be? And those are all common items that we think about when we're discussing retirement strategy. And for most Americans, their largest investment is their home. It's not uncommon for me to meet people that I speak with and show this product to. They've lived in their current home for 20, 30, up to even 50 years. It's not unusual. And of course, during that time, they built a substantial amount of equity. So what if you decided to retire and you still were making monthly mortgage payments? How would your retirement cash flow look if you did not have to make those payments? something to think about. So when you think about your cash flow in retirement, think about cash flow in retirement. You leave a fairly well-paying job. Excuse me. Maybe you've both been working. If you're a married couple, had a nice income. You retire, that nice income is no longer there. Now you have to go to the investment side and your portfolio to draw income, and including Social Security. But what if you find out in retirement that your cash flow is just not where you need it to be each month? What are your options? You could get a job, and a lot of people are definitely doing that. You see a lot more folks working into their 70s and even into their 80s. You can sell your home. That's a great idea. You might have a large 5-6 bedroom home. It's just you and your spouse. All the kids are gone. Big yard. You don't want that any longer. You call Jason, and he can help you find a home that's more right-sized or downsized for you. So if you've decided to retire and your cash flow does not leave a lot of room, you might want to refinance. Now, refinancing is great. You get a home equity loan, but the problem is you're going to have a payment. The more you draw from your home equity line, the higher your payment's going to be each month. Or another option is to get a HECM loan. What exactly is a HECM loan? Well, it's the government-insured loan. It stands for Home Equity Conversion Mortgage. HECM is the acronym. Designed for homeowners at the age of 62 or above, and it's commonly known now as a reverse mortgage. And the biggest benefit by far is there are no monthly mortgage payments required as long as you're in the loan. But you must continue to pay your property taxes and homeowners insurance and maintain the home. And those are the main items. And you must live there as your primary residence. You can't get a reverse mortgage and rent it to go live somewhere else. So, what are the advantages of a reverse mortgage? First of all, you are always on title to the home. About the biggest misconception with reverse mortgages is, let's say you have a $600,000 home and you qualify for $350,000 in a reverse mortgage. And we'll talk about qualifications in a minute. A lot of people think you're selling your home to the bank for $350,000 when it comes time to pay the loan back, you just give the house back. That's totally not true. With this mortgage insurance that's built into the program, you'll never owe more than what your home is worth. You could take out one of these at 62, and if you're a couple, it's a very high percentage that one of you will live into your 90s. So that's 30 years of being in the same home with never making a mortgage payment. You could end up owing more than what the home is worth. In that case, then let's say your heirs at that time they could just return the home to the lender. They will not owe anything more than what the home brings at sale. So you would not be passing on any type of debt to your heirs or estate. You can stay in the home for as long as possible. A lot of people think that, what if my loan balance becomes more than what my house is worth at that time? That is not a factor. You can stay in your home for as long as you possibly can. And obviously, you will eliminate monthly mortgage payments. Again, you're responsible for your real estate taxes and homeowners insurance. Most counties in the D.C. area here offer up to 100% real estate tax relief, so that's something that if you're considering this, you could look into too, and that could be part of the plan. And how are the ways you can take the equity that you built up in your home? Several ways. You can take a lump sum cash option. I've had folks take lump sum cash. They've started a business for their children or grandchildren. They've put a grandchild through college or had the money there so they could go to college. I've had folks take out a lump sum and buy another property. It looks like a vacation property that the whole family can use. So you can do the monthly payout. The lump sum payout. Another option is the monthly payout, and you can take that each month, and those proceeds are tax free. They do not need to be reported on any type of tax forms, and that's by IRS statute. It's not considered income, it's considered proceeds from a loan. You could keep some of the money in a line of credit, and the line of credit has a built-in guaranteed growth factor. It's usually roughly equal to the amount of interest being paid on the loan. So if you're accumulating, your balance is accumulating interest of 4%, your line of credit on your will be growing at 4% also, somewhere in that range. Basically, if you start out the loan with a $100,000 line of credit at 4%, at the end of 1 year, you'll have $104,000 in your line of credit. Now, that was built into the program for a couple factors. The older you are, the more of your home's equity is available to you. And two, we do assume that the asset that we're lending on, the home, is going to appreciate in value. So that's why this line of credit is built in, and it's a great feature, and financial planners really like that. And you could do a combination of these. You can switch from one to the other at any time without any type of penalty or anything. So these are very, very flexible loans. And how we calculate the amount that your home, how much of your home's equity is available to you with a reverse mortgage is we use the age of the youngest borrower. So if it's a couple and the husband, let's say, is 70 and the wife is 63, we will use the 63-year-old's birthday in calculating. We'll determine the existing equity left in the home. The numbers will be based on an appraisal. An FHA appraisal must be performed, and the number that the appraisal comes up with, that'll be used to determine the percentage of your home's value. And the current interest rate, which is, they are at pretty much historic lows right now. This is just run through real quick. Most all lenders at this point are local, nationwide, HUD approved, members of NERMLA, and accredited. So if someone's interested, contacts me for a reverse mortgage. I will obviously make those calculations we just talked about, but I'd love to set up in-home consultations. I believe this is the type of product that really has to be explained in a face-to-face type meeting, so you can look at the numbers and go over them and make sure everybody understands. And at these meetings, I love having interested children there, or your financial advisor there, your attorney. I would say the more the merrier, because I want to make sure that everyone understands how the product works, and also that everyone involved is on the same page, so we don't have any miscommunication. This is true. Every situation is unique, so I like to tailor the programs to fit the specific needs of each individual borrower, and we can do that. I am going to now switch gears a little bit. That's how the loan operates and some basic tenets of the reverse mortgage. I'm going to flip into now some of the ways that reverse mortgages are being used in financial planning strategies. Here we go. Number one we're going to show here is that HECM growing line of credit. Financial advisors love having different buckets of assets to draw from. This is certainly built up home equity, could be a bucket that you could draw from at any time. And again, it's tax-free. When you set up a financial plan, go to your financial planner, considering retiring, you're 60 years old, you want to retire at 65. These planners take your current assets and what your future assets might look like and come up with a plan. They're very good at doing that. But what happens, this one factor is you've got this plan, you put it in place with the assets you have, and one of the spouses gets sick. Well, if you have long-term care insurance, you've got a way to take care of that and avoid that time bomb. But if you don't, that could be a very hefty monthly obligation that you haven't planned for. Having the reverse mortgage line of credit could be a way to mitigate that. You can draw from that at any time to help pay and cover for health care expenses. Number two, something financial planners refer to as sequence of return risk. Let's say you retired last year and you're starting to draw from your portfolio, and then this COVID situation happens and the market took a 20-30% drop. Well, if you're selling those assets that you've accumulated in your investments at lower pricing, you're going to be depleting your investment portfolio at a much more rapid pace. So a strategy that's being used is you've opened up the reverse mortgage line of credit. When you see a market downturn, you stop taking money from your investments. You shut off that spigot and you turn on the home equity line of credit spigot to get your monthly income from. And that has been proven by Dr. Pfau and many others that that strategy alone really improves your chances of having an overall successful retirement. We talked briefly about this a little earlier. You have the big home, doesn't really serve you as well. You're tired of mowing the grass, and you've been to your friend's 55-plus community, really like it. You want to look into, that's where you want to go. You want to purchase a new home in your retirement age. There is a reverse mortgage for purchase. In this example, you've sold your home, you had $500,000 in equity, you want to purchase a brand new home, and it costs $350,000. There's two ways to have no mortgage payment in your retirement years. You buy your destination home all cash, or you use a reverse mortgage for purchase to acquire that asset. In this situation, the HECM provides $150,000 of the purchase price. You bring $200,000 in cash to the table. You have your $350,000, and you have purchased your new home. You do not have a mortgage payment to make, and you still have $150,000 of that equity from the sale of the property to use at your discretion, and then to keep it in your investment portfolio or use it for any other purpose. So really frees up a lot more cash flow in retirement. As you know, Social Security can begin at 62. I'm going to go down to the bottom left here. When you take Social Security at 62, you're only going to get 75% of what you're eligible for, because the retirement age is now 66. Full retirement age is 66 years and 4 months. I'm 64 and 3 months, so I'm looking into it, and I was on Mr. Norse's webinar a week or two ago on Social Security. It was very, very informative. So you can see at the bottom, if you wait till you're 70, you're getting almost $1,800, so almost $800 more per month. You could use the reverse mortgage and the line of credit to bridge that gap to give you the income you need instead of taking it from Social Security. So that's a strategy that's been used. And since the HECM reverse mortgage, all proceeds are non-taxable, you can draw from your line of credit to reduce your yearly income if you're above a certain level, and your capital gains taxes are really taking a hit on there. You could reduce your taxes so you have a lower tax rate, and that also helps with portfolio longevity. So those are some of the strategies that are being utilized today, Jason. And let's see if I have one more here I want to show you, and then we can maybe get into some questions.
Perfect.
And let me just show. I have the right. Don't have it at my fingertips. Sorry, but I can just tell you that. Well, there it is. These are a little comparison between getting a home equity line and the HECM line of credit. I mean, many folks say, well, I can just get a line of credit. It's going to be a lot less fees, and why wouldn't I do that instead of getting the home equity line of credit? Well, with a home equity line, you have monthly payments that are required, usually interest only for the first 10 years, then starts amortizing for the rest of the term, and that could really, people get a sticker shock when they start having to pay interest and principal on those. Home equity line, no payment. There's no home equity line of growth on the HELOC side, but there is on the HECM line of credit. This happened after the crash in 2008. You had a $100,000 home equity line with your bank. They called you and said your home equity line is now $50,000 because of the prices, the home value prices from the recession there. That will never happen with a reverse mortgage. You always maintain the same growing line of credit as long as one of you is living in the home. The due date on a HECM is when the last eligible borrower is no longer living in the home. That's when the loan becomes due and payable full time. They've either both passed away, they've sold the home, or they've had to go to like a nursing facility full time and can't live in their home. That's when the loan's due and payable. You have due dates with the HELOC. You might have a prepayment penalty. For the HELOC, the HECM line of credit, no prepayment penalty at all. These are fully insured by the FHA. HELOCs are not. Sometimes you have annual fees with a HELOC. There are no fees with the HECM line of credit. So that is what I wanted to go over today with everyone. Jason, if there are any questions,
Yeah,
I'm glad to handle those right now.
Got a few questions, Ernie. Perfect. Thank you very much. First question, somebody asked, is it true that in a reverse mortgage that the lender actually owns the home?
No. We touched on that briefly during the slideshow. You always maintain title to your home. It's just a lien that's recorded just like a regular mortgage. But you always have title. You get a reverse mortgage. 5 years later, you decide you want to sell it. You don't have to ask permission or anything. You just find Jason, have him sell your home for the best price, and just pay off the mortgage when you go to closing, and you keep the rest.
Good. And somebody asked, just for clarification, do you have to own your home free and clear to get a reverse mortgage?
That's another common one. I'm glad you asked that. Yeah, there's a perception out there that you have to own your home 100% free and clear. That is just not true. What has to happen, though, is any liens against the property must be satisfied. So the reverse mortgage could be in first lien position. So we do the calculation. Let's say you have a $600,000 house. You have a $300,000 mortgage on it. We do the calculation. We see that you will qualify for $350,000 in a reverse mortgage. We would pay off the $300,000 loan at that point, and you'd have $50,000 left over, either to use in cash or payments or in a line of credit.
What happens if you use up all the money in a reverse mortgage? What happens then, Ernie?
Okay, you get monthly statements, and depending on what you've utilized, it'll show what your balance is. And as the months and years go by, with interest accruing and things like that, let's say you've utilized all the money that was available to you in the reverse mortgage, and you owe, and you see that your balance has gone above what your home is worth. Now, nothing would happen. You could stay in the home for as long as you possibly can. There just would not be any funds available to you through the reverse mortgage, but all the terms as far as staying there and not making payments would remain in effect.
And then
That
to
might be
clarify,
true. I was just going to say that that's going to be more true in maybe areas of the country where the housing values aren't where they are here in the Washington D.C. metro area, where folks have a ton of equity.
right? And to clarify, Ernie, since you're going off the approval process, the youngest individual, so when that person passes, that's when the reverse mortgage needs to be paid back, correct?
Well, here's what happens in the situation where you have a married couple. If the older, let's say the older, well, it doesn't matter. If one of the spouses passes away and the other spouse that was on the loan is still alive, still living in the home as their primary residence, the loan just continues as is. If you were getting monthly payments, you'll still consider getting, you'll still get the monthly payments. I just want to say one caveat though. If you're a married couple, as long as one of you is above the age of 62, you can do the reverse mortgage. However, the younger borrower would be considered an eligible non-borrowing spouse. So you get the reverse mortgage. The husband at the time was 70, the wife was 59. 10 years later, he passes. The younger spouse would still be able to live in the home for as long as they possibly can. However, they would not have access to any of the benefits. Let's say if the older one passed, there was $100,000 in the line of credit. That not eligible non-borrowing spouse would not have access to those funds, but could live in the home without ever making a payment until she could no longer live there.
From beginning to end, Ernie, so if somebody is thinking about a reverse mortgage, so the minute they call you, what's the typical time frame for approval and for the actual reverse mortgage or for the HECM to actually to start?
Well, that's a good question. We are in the COVID era right now. Before COVID, I would say the typical process was about 35 days. Now I'm going to say it's more like 45 to 50 days, simply because everything is taking longer. Taking longer for title work to come in, taking longer for appraisals to come in, and those type of things. So my typical answer for my new borrowers is expect it to be in the 45-day range from counseling and application to closing.
You had mentioned, Ernie, some of the reasons that why somebody would consider a reverse mortgage, whether it's long-term care, health. Are there some other reasons why you think when you sit down with somebody that maybe a reverse mortgage does make more sense?
Well, yes. I mean, a lot of folks want to remain in their homes for as long as possible. But as you're aging, your home is not aging with you, let's say. So a big reason why people do this is to have the monies available to be able to retrofit the home so you can age in place easier. That's a big reason. Funding for long-term care, that's another thought. Just basic monthly cash flow improvements. Just by paying off an existing mortgage and having that $1,200, $1,500 available in monthly cash flow to do the things you really want to do is desirable for a lot of folks.
Right. Last question. So you, DC Metro, if somebody is living, let's say in Iowa, and they were interested in a reverse mortgage, could they call you? Do you recommend somebody else? How can people find you?
Well, let's see. I'm going to put something on the screen here. Oh, there we go. This is my number and my email. We're a national organization. If someone is in a state that I'm not licensed in, I could certainly, I'd be glad to see if the loan could work for them. And if it does, I would put them in contact with somebody in their state that could help them. I'm licensed in the district, Maryland, Virginia, and the state of Florida.
Okay. And for those that are going to be listening to us on our podcast today, Ernie Castro, Castro, your phone number is 703-447-7036. And your email is ecastro@aag.com, ecastro@aag.com. Is there anywhere else or any other way that people can get a hold of you, Ernie?
Well, these are the two best ways to get a hold of me.
Okay.
We are coming up with our own personal websites. They're in development now, but they're just not available from AAG.
Okay, we're good.
But,
well, very good stuff,
so
Ernie.
I monitor these constantly. So, I grew up in the restaurant business. I don't mind being available 7 days a week.
Very good. Well, Ernie, thank you so much. Really good information. Hopefully, people will start to explore the options as they get to retirement and consider a reverse mortgage. So once again, my name is Jason Kotar. I am the host of Knowledgeable Aging.